The past few weeks have been marred by news of startup valuations being slashed by venture capitalists and investors. Swiggy's valuation was cut by Invesco, BYJU'S was slashed by BlackRock, and Meesho's was reduced by Fidelity. Now, these cutbacks are also expected to translate into lower returns from ESOPs, which were used as a means by these companies to attract top talent. Business Today TV's Aakanksha Chaturvedi joins us with more on this. Aakanksha, how will the valuation cuts impact employee ESOPs? What have you learned?
Well, in very simple terms, ESOPs are basically equity in the company in which the employees are working. This is granted to them in the form of remuneration by the company. So, what happens is at the time when the ESOPs are granted, they're granted to employees at a rate which is called the strike rate, which is usually lower than the market rate at that point in time. And moreover, the strike rate of the ESOPs depends on the valuation of the company at that point in time. So what's happening here is in the normal due course of time, it's expected that once the ESOPs have vested, employees can go out and sell the ESOPs at their strike rate. And since the market rate is, of course, going to be higher than the strike rate, the difference between the market rate and the strike rate is the employee's profit. But now, in situations like this, where the valuation of the company has reduced, it's most likely that when these employees go out with the strike rate at which they had received when the valuation was high, and when they try to sell their ESOPs, the difference between the market rate and the strike rate is not going to be as much as they were expecting before at a higher valuation, which means their monetary benefit and profit is also going to reduce. So that's how the valuation of ESOPs has changed with the devaluation or the reduction in the valuation of these companies.
How do you think employees are likely to react to this, Aakanksha?
Well, there are two likely scenarios in which this is going to play out, at least in the short term. For starters, it's going to be extremely difficult to retain talent which is already working at these companies. It's because these employees had a set monetary figure in mind when, they had gotten these ESOPs. They thought that this is the amount of profit or monetary benefit that they're going to get out of the vested ESOPs. But that's not going to happen when they're going to cash it out, at least in the near term. The next issue that's going to happen, like you just said some time ago, is that ESOPs were a means to attract top talent. And if the ESOPs or the monetary benefit out of ESOPs is not as employees or outsiders or the top talent thinks it is, maybe they would not be more willing to work at these companies.
If you like the video, do like, comment, share and subscribe.